That's what I would tell you about the GAO.
What do you think makes the Fed more immune to review than the defense? What's the rationale behind that, do you think?
Well, again, everything we do on payments and financial regulation, every single thing we do is subject to GAO audit. And these are policy audits. It's not like a financial audit. The public should understand that we are audited. Our business model is actually about as simple as that as a very small community bank. It's not complicated, and we're constantly audited. What this exemption does is it prevents the GAO from coming in and looking at and assessing individual monetary policy decisions, which Congress saw fit, you saw fit, your Congress saw fit, to carve out of the law. And I think it was an appropriate thing to do, and I think it would be unwise to take a step back from that. I don't see any harm that it's doing.
Well, the former chairpersons of the Fed have indicated they simply did not want to be second-guessed on their decisions, that the public really doesn't have a right to know. I find that illogical, quite frankly, and that's why I asked you these questions.
I mean, we're very transparent. We publish minutes. We publish transcripts.
I know. We publish
We're not hiding anything.
We publish everything but, and I'm just, I think the but exemption is overdue.
The gentleman from Missouri, Mr. Clay, who is also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being here today. For most of the constituents in my congressional district, they are not focused on the Dow maintaining a 30,000 level, but simply trying to make ends meet. In fact, the St. Louis Fed, in an essay as part of its Demographics of Wealth series, examined the connection between race or ethnicity and wealth accumulation. Over the past quarter century, it was the result of an analysis of data collected between 1989 and 2013. Through the Federal Reserve Survey of Consumer Finances, more than 40,000 heads of households were interviewed over those years. Median Hispanic and Black wealth levels are about 90% lower than the median white wealth level, yet median income levels of Hispanics and Blacks are only 40% lower. The larger racial wealth gap could be due to Hispanics and Blacks investing in low-return assets like housing, as well as to borrowing at higher interest rates. Hispanics and Blacks could also feel less of a need to save for the future because society's progressive old age safety net programs will replace a relatively larger share of the normal incomes they earn during their working years. Could you comment on why many communities continue to lag and how the Fed, via its monetary policy, might seek to address some of the underlying factors that have led to gross inequality?
What we can do, and what we have been doing, is to take seriously your order to us to seek maximum employment. And that's what we're doing. I think we've just learned because we've been watching what's been happening, that unemployment can be lower than many had expected without raising inflationary or other concerns. So that's what we can do, and we will continue to do. And I think that's showing up in communities everywhere. I think other governmental and other tools are necessary to address longer run problems, though.
Such as, how do we address the pay inequity? How do we impress upon corporate America that it does its country no good to have a persistent pay inequity among its workers, especially when you look at the disparities in the races and the pay inequity?
I will say, I think it's important that those issues be addressed. It's really not for the Fed to prescribe the measures to address them. We need to stay in our lane. We do have this grant of independence, including the GAO exemption, and I think to keep that, we need to stay with what you've given us to do, which is maximum employment, stable prices, supervise the banks, look after financial stability.
And on another subject, will the Federal Reserve release its own proposal on the Community Reinvestment Act, one that takes into account the needs of low and moderate income communities?
We haven't made a decision on that yet. I think our focus right now is on the ongoing process of the other agencies' proposal and the comments. I think we're going to learn a lot from those comments, and I suspect there'll be changes to that proposal coming out of the comments. And you know, so we have not made a decision about our own proposal.
Well, traditional monetary policy works through a single economy-wide variable, a single interest rate, or perhaps the money supply or growth of credit. Credit policy, by contrast, aims at directing credit in specific forms towards specific groups of borrowers. Credit policy consists of a central bank operations targeting specific segments of the private debt and securities market. What is your view of shifting from traditional monetary theory to one that involves a use of more tools in order to enhance borrowing to segments of society?
So I think that has historically not been a function of the Fed and of central banks generally. We have, as you pointed out, one tool, which is our interest rate policy. When you're talking about affecting different sectors of the business community or of the population, that really should be another agency or Congress itself in fiscal policy rather than.
The witness is requested to continue to provide an answer in writing for the record.
Thank you.
The gentleman from Missouri, Mr. Lookemeyer, is recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Always good to see you, sir. I'm sure you saw the speech and probably read or heard the speech by Vice Chairman Quarles on the need to reform banking supervision. One area I think needs clarity in the supervision regime is the role of guidance. I pushed regulators to clarify the use of guidance, and in 2018 he came out with an interagency statement on guidance. However, Vice Chairman Quarles in his speech urged an additional step, doing a rulemaking of the role of guidance. This fits with Trump's administration recent actions out of the Office of Management and Budget. My question is, do you believe we need an official rulemaking out of the Fed on the role of guidance?
We have not made a decision on that. We're, like the other agencies, we're evaluating the OMB memo. As you know, guidance is not enforceable. It's not, and so we do understand that. Guidance is not a rule.
You know, Mr. Quarles was here recently, and I think he made the comment that he intended to look at all the guidance and separate out what he believed needed to be under rule, and the rest of it then be clarified as strictly guidance. And I think that's a great approach, but I think the question is, do you anticipate a rule to be able to do that and force that in the future? And so you're looking at trying to do that.
That's something we're looking at, and we are looking at our guidance and asking if some of it is more like a rule.
Okay. Mr. Quarles also discussed how regulations have a framework under the Administrative Procedures Act, but there is no real framework for supervision. He used LISIC as an example of supervision that was conducted without appropriate oversight and does not have specific guardrails. In fact, the GAO said this should have been conducted as a rulemaking. Do you believe we need to change LISIC, and what should we do to the firms that are already under this regime?
So I would agree that it's appropriate that we draw brighter lines around LISIC membership, and as Vice Chair Quarles mentioned in a speech recently, that's the path we are on.
Okay, very good. Something that is kind of concerning to me is the fact that we have a lot of banks and non-banks that are in the home mortgage lending space. Non-banks in general were roughly lending about $250 billion in 2016. This next year is anticipated to triple to $750 billion. In 2019, non-banks originated 85% of all loans sold into securitization guaranteed by Ginnie Mae. 53% of loans sold to Freddie Mac and 60% of loans sold to Fannie Mae. And non-bank mortgages make up 87% of FHA's portfolio. In our most recent FSOC report, non-bank mortgage originators were designated as a potential systemic risk. You're a member of FSOC. Can you explain that? Would you like to talk about that a little bit? And do you have any concerns over that? Obviously, FSOC did.
As you mentioned, we have looked at that at FSOC, and I believe it was part of the recent annual report. The thought being these are now very, very important channels through which mortgages are originated. And in a case of a downturn, the banks have high capital, they've got lots of regulation, lots of liquidity, and that's in a good place. But these institutions are operating sometimes under, funding themselves with credit lines, which might not be available. So there's risk there, and we're in the process of assessing that and determining what all to do about it. It's
you have a timetable on that?
We've highlighted as a risk, and we're doing work on.
Do you have a timetable on what you might come out with a statement and say you will or will not do, and if you want to do something, what it may be?
I can come back to you. This is something that the Treasury has the lead on, but
Okay.
yeah.
Okay, very good. One of the things that concerns me a little bit is also with regards to home lending is just the stack of forms you have to go through. I mean, we had a gentleman here who represented, it was actually a credit union at the time, but the stack was literally this tall, and I asked him how many pages were in there, and he said, Congressman, we don't no longer measure by the page, we measure by the pound. I said, this is how off the charts we have gotten when you have a stack of papers this tall to do a home loan. I've talked to the FDIC and the CFPB, and hopefully we can engage you in a way to kind of reduce that down to where it's manageable, to where still there is protections in there for the consumer when he signs for a loan, and there's enough information to allow the bank and the regulators to see it. But this has got to change. This can't continue to grow. This is crazy. You have an opinion on that?
Well, to the extent it's not legally mandated, a lot of that stuff is legally mandated by federal or state law. To the extent it's not, then we do try to make assessments about what is necessary and what's not, but it is a big challenge. I would agree.
Thank you. I just want to note for the record, I did not ask a question about CECL today. Thank you very much, Mr. Powell.
The gentleman yields back. The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Welcome, Chairman Powell. Good to have you. Chairman Powell, concerning LIBOR, the Alternative Reference Rate Committee is pursuing in New York legislation to address legacy contracts in New York State. Would the Fed support federal action in that regard?
Mr. Scott, so actually it's some members of the ARC. The Alternative Reference Rate Committee itself is not seeking legislation, but some members have approached the New York legislature. In terms of the need for federal legislation, we have not reached a point where we think it's going to be necessary. We have plans to do that. If we do believe that federal legislation is necessary, we will come tell you. And by the way, we understand that that's not something you can do in 24 hours, so we know that the time for that is soon.
Very good. Let's move over to Great Britain for a moment. The UK regulators have been very direct with their financial institutions, and they recently established a goal for their institutions to cease LIBOR-based lending by the third quarter of 2020. So why has the Fed not been so direct? And do you have plans to set clear goals and guidelines for your regulated institutions?
Yes, we will do that at some point. You may have seen that Fannie Mae and Freddie Mac have said that they won't accept LIBOR referencing mortgages after some point later this year. So that sort of thing will begin to happen now, I think, well in advance of the deadline, which is the end of 2021.
Okay, and Chairman Powell, your Fed board recently finalized its rule on tailoring the hopes of providing more clear and well-defined risk indicators to determine the regulatory requirements that are placed on firms based on their size and risk. But the board has never disclosed nor provided clear and quantitative criteria under which firms are placed under its enhanced supervisory regime that is called Large Institutions Supervision Coordinating Committee. And even your vice chairman, Mr. Quarles, recently gave a speech where he said this. He said that he would like to align their portfolio with the tailoring categories and make the designation criterion transparent. And you even recently indicated that you agreed on the need for brighter lines. So could you outline what changes the Ford is considering to make in this supervisory framework?
We're just in the process of working out the specifics, but I would agree that we should provide more clarity around what is a LISIC firm, and that's really going to be the Category 1 firms.
Thank you. Now, let's move to, and you're a great man and a good friend. I respect you tremendously. But Chairman Powell, the Fed is the axle of our financial system. You are the most powerful regulator. And I want you to stand back up to Mr. Otting on this business of him coming with this rule-making change to the Community Reinvestment Act. Let him know that you not only have a mandate for inflationary monetary policy, you have a dual mandate, employment, jobs. And here's the other thing. You need to remind Mr. Otting that this piece of legislation, this law, the Community Reinvestment Act, is precious to the nation, but it's precious to African Americans more than anybody, because it wasn't the Civil Rights Act, wasn't the Voting Rights Act that dealt with the big issue facing African Americans, financial stability. And the two anchors for that is a home, owning a house, and having a job. And this bill was the bill that outlined redlining that kept African Americans out. He needs to back off of that. You need to assume your power in this and let him know we're serious and to back off this rule change.
The gentleman from Ohio, Mr. Stivers, is recognized for 5 minutes.
Thank you, Madam Chair. Appreciate you holding this hearing. Good morning, Mr. Chairman. How are you doing today?
Great, thanks.
Great. Thanks for being here. I want to do some yes or no questions. You covered them in your testimony, but just to remind everybody, the labor participation rate is now 83.1%, which has increased in the last 3 years. Is that correct?
I think that's prime age.
Sorry, prime age. That's the prime age adults. Sorry, yeah.
Has it
increased or decreased in the last 3 years?
I believe it has, yes.
And wage growth has outpaced inflation for workers in the last 3 years. Well, at least is currently outpacing inflation, correct?
Yes, it is.
Wage growth has actually gone up by about 3% the last few quarters in an annualized rate. Is that correct?
Over the last few years, if you look at a range of measures, then you would see wages moving up at about 3%.
And we have record low unemployment rates for African Americans and Hispanics. Is that correct?
That is correct.
So the fundamentals of the economy are in pretty good shape. Would you say that's correct?
I would, and I did.
And you did. Thank you for that testimony. So your colleague at the Atlanta Fed stated recently that an economic expansion does not die of old age. I think that's a great quote. Given that the fundamentals of the economy are strong, do you think many businesses and investors are trying to talk themselves into a recession?
I don't think so, and I certainly hope not. There's no reason why the expansion can't continue. There's nothing about this expansion that is unstable or unsustainable. Great,
and I think the fundamentals are strong, but I think a lot of people are worried, and I hope that they don't talk themselves into a recession. I agree with you on that. Given that about 2/3 of all lending and capital formation occurs in the capital markets, I'm curious to hear about what the Federal Reserve is doing to actually coordinate with the Securities and Exchange Commission and the CFTC as prudential regulators for the capital markets to make sure that there's actual coordination on the capital markets.
Well, I mean, the SEC really and the CFTC really have primary regulatory authority for those markets, and we have supervisory regulatory authority over the banks. Where we overlap really is in financial market utilities, where we regulate some, and the SEC regulates some, and the CFTC regulates some, and we collaborate on all that. So we collaborate pretty closely on that.
Well, I would urge you to increase that collaboration because the lines between securities, banking, and capital markets are blurring more than ever before, and I would ask you and Vice Chairman Quarles to redouble your efforts for that coordination, because I do hear it from some of the firms that are regulated that they feel like it's not coordinated. So if you could redouble those efforts, I'd really, I think that would pay dividends to the American investor and the American economy. A couple other quick questions here. What do you think the most significant risk to the financial system is today?
So I mean, I have to start by saying that I think the financial system is strong and has been materially strengthened since the financial crisis, particularly the banks, high capital, high liquidity, stress tests keep them on their toes, and they have real resolution plans. None of that was really in place before. So I think the financial system is generally in a good place. The thing that we worry about a lot is cyber attacks. I think we have a great game plan for traditional issues like bad loans and things like that. It's more cyber attacks is really the frontier where you worry. And we work very, very hard on that. All the agencies do. We all work together. The institutions themselves work very hard. But that, I would say, is a major focus.
Thank you. And an interesting note, Mr. Chairman, you are in line with the CEOs of the biggest institutions. I asked them the same question, and the consensus, although not complete unanimous agreement, was that cyber attacks were the issue. I think Congress needs to focus on it. I think our regulators need to focus on it. Two quick things, because I'm running out of time. I know you're focused on the transition between LIBOR and SOFR. Some people have asked that question. I hope you'll pay particular attention to the impact on both small businesses and our community banks as we make that transition. They are particularly vulnerable. And with regard to the repo market, I hope you will continue to focus on the origins of the problem that caused it. Some are regulatory, some are market-based. And I know you're focused on it. You and I have had private discussions about it, but I'd like to see that solved in a way that you don't have to provide Federal Reserve capital at the end of every quarter or at the end of every year. So if you can stay focused on those things, I'm out of time. Thank you, Mr. Chairman.
Thank you.
The gentleman from Texas, Mr. Green, who is also the chair for the Subcommittee on Oversight and Investigation, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you for appearing today, Mr. Powell. Mr. Powell, this is an observation, not a criticism. You indicated that the fundamentals are strong. However, you also indicated at the last FMOC press conference that you were a bit surprised that wages have failed to move up despite being well into an expanding economy. Sustained levels of historically low unemployment and increased labor force participation. Fundamentals are strong. Strong, yet nearly half, 42.4%, of working Americans in 2019 made less than $15 an hour. Fundamentals are strong. Good many of the people in my congressional district, Mr. Powell, are more concerned about the supermarket prices than the stock market. When they go to the supermarket, they're concerned about the price of Procter & Gamble products, not the stock market price of Procter & Gamble itself. The stock market means nothing to them. It's what they have to pay for products in the supermarket. This brings me to my question. Has there been a study to give us some sense of what a $15 an hour wage will do for the economy. A study for what a $15 an hour wage will do for the economy. Has the Fed done such a study?
The Fed has not. That's not something we would do. But
Well, let me just address that, if I may. Don't mean to be rude, crude, and unrefined, but let me just call to your attention a study that I found quite interesting. The Carbon Disclosure Project. Good project. Based on thousands of disclosures, you've concluded that the 500 largest companies by market capitalization are exposed to $1 trillion in risk. Now, someone could argue that that's probably not something that you ought to do, although I understand that climate change is something that is important to the Fed because it will have an impact, global impact. But I think you can take a closer look at this. You're the ultimate authority on price stability, on wages. Let's have a study to determine what impact a $15 an hour minimum wage will have on the economy. A wage disclosure project, if you will. Give me some thoughts, Mr. Powell. Can you help us, please?
there's a great deal of research that's been done on minimum wages, and I don't know of a particular one, but there has to be somewhere research on what a federal $15 wage increase.
And I agree with you. I agree. I've read a few. But they don't come from the Fed. They don't come from the entity that has the dual mandate, price stability, unemployment or employment. It would mean something to working people if we could get such a study, notwithstanding what others have done. And these are observations, Mr. Powell, not criticisms. I've enjoyed visiting with you. Notwithstanding what others have done, this would be meaningful to working people. By the way, I think $15 an hour is not enough as a minimum wage. I think it ought to be at least 20 now, but I'll still settle for 15 if we can get that. So can we work with you, discuss with you the possibility of a wage project?
You know, again, I'll go back and talk to our labor people who know this issue very, very well, and many of them have published on these issues. So let me come back and.
I'm going to thank you for it. I've got 46 seconds, and I'm going to applaud you for it. Personal applause. Madam Chair, with that, I will yield back the balance of my time.
Thank you very much. Is the gentleman requesting to have an answer in writing for the record on this question to the chairman?
Yes, Madam Chair, thank you.
The witness is requested to provide an answer in writing for the record. Thank you. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Madam Chairwoman. Chairman Powell, welcome back to our committee. And I want to first touch on your testimony about the importance of fiscal policy in supporting the economy. In general, what would you say is the lag time associated with a major change in fiscal policy?
Well, it can tend to be long, as you know. We can, with monetary policy, we can go into a room and change interest rates, and do. Obviously, fiscal policy tends to take a lot of work and some time.
Well, let me ask you this. Let me ask the question this way. Fiscal policy has changed profoundly in the past 3 years. Tax cuts, deregulation, a less restrained energy sector, a pullback from Dodd-Frank, repeal of the individual mandate, new trade deals. Are any of these policy changes impacting current economic conditions?
I'm sure they are, but of course we don't try to assess that. That's not really what we do when we look at the economy. But yes, they would be affecting.
As you noted in your testimony, the U.S. economy is presently exceptionally strong. Since the 2016 election, 7 million new jobs have been created. The unemployment rate is at a 50-year low. More Americans are employed today than ever before. Wage growth is the highest in a decade, and the lowest income workers have been seeing the fastest pay increase, growing at 16% since the 2016 election. And just over the weekend, this was the headline of the Wall Street Journal, which I'm sure you follow, and the reporting was that a tight U.S. labor market is drawing Americans off the sidelines at a record rate. Despite this, after last week's State of the Union speech, Speaker Pelosi said that it was, quote, appalling to hear the president, quote, try to take credit, unquote, for an economy he inherited. Now, Chairman Powell, I'm not going to ask you to weigh in or arbitrate a domestic political dispute, but when the FOMC conducts monetary policy, given what you said about the lag time of fiscal policy, is it fair to say that this president's policies are impacting today's economic conditions?
At a high level, of course, they are.
Let me follow up on Representative Wagner's question about the GSIB surcharge. In your response to our letter, you maintain that you aim to have the, quote, key components, unquote, of the stress capital buffer finalized in time for the 2020 CCAR. Can you describe in more detail what the key components are and a more precise timeline, given that the Fed announced last week scenarios for the 2020 CCAR?
So I think the timeline is we do intend and will put into effect the core of the stress capital buffer in time for the 2020 CCAR cycle. So that's coming right up. I'd prefer to leave the exact details of that to the that are still being worked out, but it will happen in a timely way for the 2020 cycle.
Understand. Well, let me try to get just a little bit more detail. Is it still the Fed's view that the activation of the countercyclical capital buffer is a suitable replacement for the dividend add-on in light of the board's financial stability report from November, which stated that the vulnerabilities have not significantly changed?
We haven't made a decision on that, on using the countercyclical capital buffer versus the other approach. We have not made a decision on that.
Okay, thank you for that. We're looking forward to that decision. Final question. The Business Roundtable, as you probably remember, announced last summer that it was redefining a corporate purpose to elevate so-called stakeholders ahead of shareholders. A large investment firm recently announced its intent to divest of fossil energy, effectively limiting investment options for clients to a subset of sectors that check the environmental, social governance box. I am concerned that firms which arbitrarily limit investment offerings based on social and political pressure may choke off capital to perfectly legal, productive, and profitable sectors of our economy and cause retail investors to miss out on returns that they need to fund their futures. As a leading voice on the Financial Stability Oversight Council, will you commit to raising this issue with your colleagues at FSOC and urge that body to examine the extent to which a misallocation of resources away from shareholders to serve unrelated political errands might stifle capital formation, compromise investor returns, and ultimately undermine financial stability?
I don't know that I totally understand your concern, but I'll be happy to discuss it with you.
Well, the concern is that if shareholders are not a prime concern of corporate boards and directors, if stakeholders who have no ownership interest in the company are the focus of a corporation, then I would submit that there is a tremendous risk of misallocation of resources away from maximum shareholder returns. And I would like FSOC to take a look at that.
The gentleman yields back.
I will bring that to the authorities at the FSOC.
Thank you. I yield back.
Gentlewoman from Ohio, Ms. Beatty, is also the chair for the Subcommittee on Diversity and Inclusion, is recognized for 5 minutes.
Thank you to the chair and to the ranking member, and thank you, Chairman Powell, for being here today. Let me also acknowledge the advocates in their green T-shirts for being here today, and thank you for coming to my office yesterday and sharing what I thought was valuable information with my team. Appreciate you sitting through the hearing. Chairman Powell, in the latest edition of the Federal Reserve Survey, Consumer Finances, that was published in 2017, and it gave the breakout between whites, blacks, and Hispanics as it related to their net worth. And we've heard the statistics. I think my colleague, Congressman Meeks, talked about it, and I'm sure some others, so I'll spare going through all of those details. But what's very interesting to me, while that data seems great for those who are researching the issue, is there any way your office could break it down by regions or cities? Because when we go back home, this is one of the #1 things that I'm hearing. People are coming into my office once you get through healthcare and this couples in with jobs and education. They're saying is we look at the wealth gap, that it's getting wider. It's not coming in. And while we're talking about unemployment rates being better, many people have to work 2 and 3 jobs just to try to survive. Someone talked about the minimum wage. Certainly, as we're advocating for a higher number, it's not enough. In my district, you'd have to make somewhere between $18.70 and $20 to be able to have a livable wage. So the first question is, can this information be localized to a region or to a city to help us as members of Congress when we go back home? The second thing is, I just recently introduced a bill closing the racial wealth gap, which requires the Federal Reserve to further break down the data. And this is something that I didn't realize until really studying the Federal Reserve, listening to some of the individuals like the folks here today. They have some really good ideas. And so my second question is, could you tell me if you would entertain having your folks look into looking at wage as a measure? Because oftentimes when you look at, many folks don't work a full-time job, but they have a wage. So could we be a little more creative in looking at the data based on what some of the things that I'm hearing from the group that came in? And I'm sure they've met with your folks and you know some of their issues. So I'll start with 2. Can it be localized? Can we entertain looking at some of the things that they think we should look at when we calculate or present all the good news that is not the good news for many of the individuals sitting here or in my district?
I think you're probably making some of our data people very happy back at the Board of Governors.
Okay.
You know, they love to cut the data different ways, and we do learn every time we do that. We learn things. I don't actually know the precise answer to your question of whether we can do it regionally or in what dimensions we can, but we'd be happy to look into that for you.
And what about some of the individuals' ideas about looking at wages in your calculation?
Yes, we can. I think we can do that. I think
So
we can
you would, your folks would be willing to work with them on some of the ideas to at least start at a starting point of discussing it? Because now we're marrying the people with the power. And what a good win-win that would be for all of us, since we're really talking about all of our lives, and especially those who, you know, have to work a little harder than some of the rest of us. And so then the next thing, will your agency work with my office? I am so excited about this bill. And as I understand it, part of the reason for asking for the data is the Federal Reserve actually collects the data that sets the policies that then get married with the allocations that come back to the districts. So I want to make sure I'm on the right path when I go back home and I say I have a bill that's asking the Federal Reserve to collect data that can help us in the end. Is that in the ballpark?
We should actually get the experts to talk directly to you and your staff and tell you what we do and how we do it and how that might be useful. I don't know that we need legislation at all, but we certainly have excellent sources of data, and we do cut them different ways. So why don't we just try to follow up with you on that?
Thank you.
Gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Madam Chair, and Chairman Powell, thanks for taking the time to be able to be here this morning. I did want to follow up a bit on the CRA. We've had a fair amount of conversation on that, and just wanted to be able to have the clarity that the Fed has been involved with the CRA process with the OCC and the FDIC. Is that correct?
From the very beginning.
Great. And also wanted to get some clarity. Were you comfortable not only with Governor Brainerd making the speech, but the content of her speech in regards to the CRA?
Yes.
Okay. What extent has the Fed been doing? I know you're talking about doing some of the analysis comments coming in, but to be able to work on CRA modernization.
So from the very beginning of the process, we said, yes, that sounds like a great idea. It's a good time to update CRA. Let's try to make it more transparent, more objective. Let's try to make it more effective in serving the intended beneficiaries. And so we too went around the country. I think we had 29 events around the country where we talked to different groups of people about CRA, their experience of CRA, and it turned us in a particular direction. We had a bunch of ideas, and you know, it's unfortunate that we weren't able to get on the same page. We weren't able to really agree completely with their approach, and they weren't able to completely agree with ours. So, but you know, we continue to push and we continue to learn, and I would agree with Mr. Hill's earlier comment that ideally you would have you know, one agreed, you know, set of standards.
I would agree with that as well. I think that harmonization is something that we certainly ought to strive for. Was really encouraged reading your comments and your statement that people who live and work in low and moderate income communities are finding new opportunities. Wages have been rising, particularly for lower paying jobs. That's an area that I have a lot of concern on. In my state of Colorado, I represent the rural areas, and we've oftentimes had two economies, to where the metropolitan areas, resort areas have been doing well. Rural areas have continued to often struggle. We're now starting to actually see some of that real movement. But when we're looking at that CRA reinvestment back, talking about the community banks, I really would encourage you to be able to look at that OCC and FDIC proposals. I believe they do reach further into rural America. And you talked about policy. Have you done any assessment in terms of the opportunity zones that were included in the Tax Cut and Jobs Act? We're certainly seeing some benefits and some investments coming into rural areas in my district. Is those some of the policies that we need to be looking at?
I'm not aware of any research that we've done on opportunity zones, but you know, we probably have. Truthfully, in the system, I would imagine we have done research on that, and we'll be happy to share it with you.
Great, thank you. And Fannie Mae and Freddie Mac just took some steps talking now about SOFR, to be accepting SOFR-based mortgages. And I've noted that other agencies have been taking this step separately. Is there any kind of uniform effort at a high level to be able to coordinate the adoption of SOFR?
Yes, there is, very much so, and we're doing that. We're coordinating with the other agencies and with the market participants as well. And you will see more of that. You will see more instances in which LIBOR will no longer work, will no longer be usable in particular contexts. And that's what Fannie and Freddie did this week, or announced this week.
And to follow up on Mr. Stiver's question in regards to community banks, do you see any pluses, minuses in regards to using SOFR over LIBOR for community banks?
Yes, I think LIBOR itself is really a problem in the sense that the rate, there's no guarantee that the rate will continue to be published after the end of 2021. But there's a question about having a credit-sensitive rate in addition to SOFR. SOFR will be the main substitute for LIBOR, but you know, we are working with regional and some of the larger banks too about the idea of also having a credit-sensitive rate, and that's something that's ongoing.
Okay. And we've had a little conversation about the coronavirus, China, the impacts on the economy. The President just signed into law the USMCA. Do you see that as creating a runway for further economic expansion in the U.S., job opportunities and wage growth?
We don't give advice on trade policy, and but I would just say this, that I think the signing and the enactment of and implementation of USMCA will be a positive, at least in the sense that it removes uncertainty around trade policy. And I think that's been part of the issue of the last year or so, has been not knowing what the rules of the game are going to be. I think getting those rules settled is certainly a positive thing.
Great. Thank you. My time's expired.
Thank you. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Chairman Powell, well, first off, I'd like to thank you for for facilitating our meeting with Governor Brainerd. Representative Hill and I had on digital currency. We really enjoyed that, as well as the meeting with the staff, who are excellent, and it's great to see how plugged in they were to this issue. Now, in a speech last week, Governor Brainerd highlighted, quote, the role of central bank digital currencies in ensuring that sovereign currencies stay at the center of each nation's financial system. Do you agree with her characterization? And in particular, do you think that establishing a digital dollar would help ensure that the U.S. dollar continues to serve as the core of the U.S. and the world's financial system?
Well, to take the first part of that, I think having a single government currency at the heart of the financial system is something that has served us well. It's a very, very basic thing that really hasn't been in question. And I think, you know, before we move away from that, we should really understand what we're doing. So I think preserving the centrality of a central, widely accepted currency that is accepted and trusted is an enormously important thing. I think whether a digital currency moves us along that path or not is an open question. As you know, every major central bank is currently taking a deep look at that we feel like that's our obligation. Technology has now made this possible. Private sector's innovating, they're doing it, so I think it's very much incumbent on us and other central banks to understand the costs and benefits and trade-offs associated with a possible digital currency.
So how would you characterize your state of progress on this compared to other countries? The Swedish central bank developing an e-krona, the Chinese. The reason that there was one of the reasons there was so much concern about the Libra project is they would immediately have scale if they just rolled out the product. Another entity in a position to do that is the Chinese government, to roll out at scale using their already established payment by cell phone systems. They would immediately have a scale comparable to Facebook if they rolled that out. And so how would you characterize our ability to respond to this potentially competitive threat?
So we're working hard on it. We have a lot of projects going, a lot of efforts going on that right now. We haven't had the problem that many of you mentioned Sweden. A lot of the Northern European economies have moved away from cash to a remarkable degree, and that really has not happened in the U.S. economy, even though it seems like it must have happened with our kids not using cash very much. Nonetheless, the amount of cash in the U.S. economy continues to grow at faster than nominal GDP. So we're in a different place on that.
If you look at the curve of adoption of payment by cell phone, it starts slowly and then all of a sudden it just happens. And so that seems like that transition can happen in a period of just a couple of years. And so we have to be able to respond. If that's the driving factor, then we have to be in a position where we can respond by rolling out, for example, a digital dollar on the couple of year time scale. And so
I completely agree with that, and I think, frankly, Libra really lit a fire under that, and it was a bit of a wake-up call that this is coming fast and could come in a way that is, that is quite widespread and systemically important fairly quickly if you use one of these big tech networks like Libra did. So we're working hard on it. We fully appreciate the importance of making quick progress. We have not decided to do this, though. It is not. I think that there are many questions that need to be answered around a digital currency for the United States, including issues of cyber issues, privacy issues. Many operational alternatives present themselves, and so we're going to be working through all of that and doing that work thoroughly and responsibly. But
do you feel as though you have adequate visibility into what the Chinese are doing on this? Do you have sort of working level contacts that give you some idea of what their rollout is likely to do, likely to look like?
Yes, I mean, we certainly have that, but they're in a completely different institutional context. There are things that, for example, the idea of having a ledger where you know everybody's payments. That's not something that would be, particularly attractive in the United States context. It's not a problem in China. So, but nonetheless,
but so from a competitive point of view, they're claiming they're going to roll it out on the Belt and Road countries sometime very quickly, and so this, I urge you to keep the fire lit. Thank you.
Thank you.
The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Madam Chairman, and thank you for coming back to our committee, Chairman. We appreciate it. And with baseball season slowly approaching, I wanted to make sure one thing before I continue, that you still are on team capitalism.
Oh, yes.
Thank you. Appreciate that. Experian recently released their 2019 Consumer Credit Review, and I wanted to read a section from the report because I think it accurately depicts the state of our economy. As you know, I'm a Main Street business guy, and the economy is really good right now. Indeed, the U.S. economy exceeded expectations. Record job growth caused unemployment rates to drop to historic lows while the stock market flexed throughout the year. Consumers, in return, showed their confidence as they continue to borrow and spend energetically, most recently evidenced by the strong 2019 holiday shopping season. The report goes on to say that consumer credit scores reached an all-time high in 2019 at an average of 703. This translates to people being able to get better rates to borrow money, to buy a house, get a small business loan, or whatever they need financing for in order to live out their American dream. So, Chairman Powell, what should we be focusing on in this committee to continue for jobs explosion and new jobs that we have seen the past few years?
Honestly, I think the focus for me really ought to be on things that address what are our longer run issues that can be addressed by legislation. And it's really two important things. One is labor force participation. What are the things that you can do that we really can't do that will help people stay more attached to the labor market? We still have low labor force participation compared to essentially all of our economic competitors. And the other one is productivity. So what is it that drives productivity? It's a stable legislative environment. It's a legislative and administrative environment that supports growth and innovation and investment and those sorts of things. So those would be my main focuses.
Okay. I know you're aware about the Fed's work on the International Insurance Capital Standard that is being developed for the world. I've had my reservations about entering into an international agreement that does not conform with our current state-based approach to regulating our domestic insurance companies. One particular piece of the international standard that I want to ask you about is the flexibility that our government was given to develop an equivalent solvency standard that would better fit our insurance ecosystems. So my question to you is, how does the Fed plan on ensuring the standards being developed in the U.S. will be deemed equivalent by the international group, given this continued resistance you're facing from the Europeans?
I can just say that we will not be part of approving any international standard that doesn't accommodate our own American insurance regulatory framework.
That's great. We're leaders, not followers. Some of my colleagues on the other side of the aisle have called for a financial transactions tax. I think this is an extremely short-sighted approach to raise revenue that will greatly impact the amount and the ways that Americans save for the future. Additionally, the thought that adding an extra layer of taxation to other assets is redundant since capital gains taxes are already in place and they should be lowered that take away money from successful investments. So if we want to further expand economic growth, we need to focus on continuing to lower the personal and corporate tax rates so Americans can keep more of their hard-earned incomes and businesses can invest that profit back into their operations. So, Chairman, can you explain how implementing a financial transaction tax would impact the U.S. economy?
I think I need to stay in my lane here. You know, we don't do fiscal policy. I don't want to get, if I start commenting on particular taxes, I'm worried about where that might go. So I'll have to.
Well, I understand that. I'll tell you from a Main Street standpoint, it will really hurt the economy, an extra layer of tax. We need to actually cut taxes. So looking at financial trends across the world and with being in business for over 50 years like myself, one data point is that catches my eye are negative interest rates. Can you help me understand the economics behind negative interest rates and talk about the potential threats that this phenomena poses to financial stability?
Well, a number of countries around the world, as you know, face the problem of what do you do when your policy rate gets to zero. And some of them actually went below zero. The United States chose not to. We chose not to at the Fed. We used other tools when we got to the lower bound, and those were forward guidance and large-scale asset purchases. I think going forward, our inclination would be to rely on the tools that we did use as opposed to negative rates. So that's our instinct, is that in the U.S. context, that's not a tool we're looking at. You know, the question about intermediation is when you have negative rates, you wind up, does it wind up creating downward pressure on bank profitability, which limits credit expansion?
Right.
And there's some evidence of that. So in any case, we were watching other institutions around the world who've done that, and we'll be able to, you know, to see what the results are.
Thank you for being here.
The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you, Madam Chair. I don't know if you know, but in 2013, Chairman, Detroit filed for Chapter 9 bankruptcy, which was marked as the largest municipal bankruptcy filing in U.S. history. In July, when you were here, I asked you why, if the Federal Reserve is willing to backstop or support, you know, big banks and corporations during periods of credit market distress, that we wouldn't want to make equally sure that state and local government also had access to credit as well. And you mentioned that you didn't have the authority to lend to local and state governments. Madam Chair, I'd like to submit for the record Section 14.2b of the Federal Reserve Act, asserting that the federal government, the feds, actually do have the authority to buy municipal debt.
Without objection, such is the order.
So, Chairman, given that you actually do have the authority, can you explain to me why we shouldn't, you know, why shouldn't the Federal Reserve ensure that state and local governments have access to funding during times of stress?
So we have, as you know, limited authority. I think it's to buy short-term municipal obligations. We did do that in the 1970s briefly, and then have not done it since. I think a series of FOMCs and Fed chairs in all kinds of different political environments have thought of that as something that's not appropriate really for us, in the sense that it's government finance. You know, that's to be dealt with by fiscal authorities rather than by the monetary authority. We focus on the job you've given us, which is maximum employment and stable prices, and to some extent also we're, with other agencies, we work on financial stability and bank supervision.
So, Chairman,
as opposed to the solvency of state and local government.
Well, yes or no, the Federal Reserve retains the ability to open emergency lending facilities. Is that accurate in stabilizing the economy?
Well, to financial institutions, we do.
So when the Fed step in to rescue banks in a crisis, is that because you believe their role in the economy is vital?
Well, really, because we had no choice to prevent the financial system from collapsing in 2007.
Yeah, no, I mean, my city filing bankruptcy was devastating to so many retirees, sir. 40, 50 years, they worked for the city of Detroit, saw their pensions completely diminished, gone. Do you not believe that the governments of Detroit and Puerto Rico also play a vital role that should be preserved, even if financial crisis makes it hard for them to borrow money?
What I believe is that that's not a job for the Fed. The Fed has a particular role and particular authorities, and you know, lending to state and local governments and supporting them when they're in bankruptcy has not been part of our mandate.
We're going to strongly disagree. I do believe you do have the authority. Now, you've mentioned that in the face of another financial crisis, you would use the same tools of expanding the balance sheet and purchasing long-term bonds. In other words, more of the same, correct?
Yes.
So I'm afraid that's simply not good enough. I mean, I think your predecessors, former chairs Yellen and I believe it's Bernanke, seem to agree based on remarks both that gave last month. For instance, Chairman Bernanke has suggested a money finance fiscal program might be helpful during the next recession. Do you agree with that would be helpful?
You know, I think that's really an untested and not widely supported perspective. I don't believe Chairman Bernanke said that a money-supported fiscal policy would be something that we should do. I know that there's been a group of people that have pushed that idea, but I don't think it included former Chairman Bernanke. You may see something I haven't seen.
I know. And Chairman, look, the federal government is supposed to be about people. And I don't see that we're treating, you know, pensioners, a city like the city of Detroit, which is frontline communities that have really been hit hard by the financial recession. I mean, we haven't actually. They keep saying Detroit's coming back. If I show you neighborhoods, they'll tell you, we don't know what you're talking about because poverty's actually increased, access to housing has decreased. I mean, all of those things. That we start reflecting and understanding that I believe the Federal Reserve Act actually gives us authority to help and treat, just like we bailed out big banks, that we can do the same for our people, the residents of the city of Detroit. So I thank you for that, and again, would actually ask and push you to looking at this from a different lens versus what the same old, the same old process, which I believe hasn't really worked for working class people. Thank you so much, and I yield the rest of my time.